Are you interested in investing in a hedge fund? Are you confused about how hedge funds work and the different strategies used? Fear not, because this comprehensive video guide is here to explain it all. In this video, we will discuss the fundamentals of hedge funds, different strategies used by hedge fund managers, the advantages and disadvantages to investing in these funds, the regulatory implications, and more. Join us as we explain all you need to know about hedge funds and lay the foundation for a successful investment strategy. Chapter 1, Introduction to Hedge Funds. Hello and welcome to our video on understanding hedge funds. The purpose of this video is to help you understand the importance of hedge funds, how they work, and the different strategies they use to generate returns. Our video consists of 6 chapters, each focusing on a unique aspect of hedge funds. This video is a comprehensive guide on all aspects of hedge funds. We will discuss both the positive and negative aspects to investing in hedge funds, as well as different strategies that hedge fund managers use. We will also talk about the tax implications and the regulatory aspects that hedge funds operate under. So, without further ado, let us begin our journey into understanding hedge funds. Chapter 2, What is a hedge fund? A hedge fund is an actively managed investment fund. It is usually formed by an investment manager who pools capital from accredited investors with the intention of generating returns that exceed those available from traditional investments. The idea behind a hedge fund is to diversify one's investments into different investment styles and strategies, creating a portfolio that is less exposed to market volatility. Hedge funds typically use more aggressive investment strategies such as short selling and leverage, as well as complex derivatives and hedging strategies to invest in a variety of asset classes including stocks, bonds, commodities, and currencies. Hedge funds are managed by professional investment managers who use their specific strategies to invest and generate returns. The fee structure of a hedge fund is also slightly different compared to other investments, as they typically have higher fees, including management fees, performance fees, and other costs. Chapter 3, Advantages and Disadvantages of Investing in Hedge Funds. One of the main advantages of investing in a hedge fund is the potential for higher returns. Hedge funds use more aggressive strategies than a typical mutual fund and often use leverage and derivatives to maximize returns. However, these aggressive strategies also have their downsides. Since hedge funds are usually only open to accredited investors, the fund size is much smaller compared to a mutual fund. This can make it hard to find a manager who can provide the necessary expertise to the hedge fund. Another major disadvantage of investing in a hedge fund is the cost. Fees for hedge funds can be much higher compared to mutual funds, and there are also other costs to consider such as management fees and performance fees. Chapter 4, Different strategies employed by hedge funds. Hedge funds use a variety of different strategies to invest and generate returns. These strategies include long-term investments, short-term trading, derivatives, leverage, and hedging strategies. Long-term investments are a conservative approach to investing. These strategies typically involve holding investments for a long period of time and are most suitable for investors who are comfortable with a buy and hold approach. Short-term trading involves actively trading in the markets. This is a more aggressive strategy that involves buying and selling securities at short-term intervals in an attempt to capitalize on short-term market movements. Derivatives and leverage are also common strategies used by hedge funds. Derivatives, such as futures, options, and swaps, provide more ways for funds to manage risk and leverage returns. Leverage allows firms to use borrowed money to increase returns, although this also comes with more risk. Finally, hedge funds may also employ hedging strategies. These involve taking offsetting positions in different markets in order to reduce risk. Chapter 5, Tax Implications and Regulation. Hedge funds are subject to a range of tax implications depending on their country of operation and the character of the underlying investments. Generally speaking, investors in hedge funds do not pay any taxes on their gains until they withdraw from the fund. This is because the profits are treated as unrealized until they are taken out of the fund. Hedge funds are also subject to a range of regulations depending on the jurisdiction they are located in. Generally, the regulations governing hedge funds concern the disclosure of financial information, the trading of derivatives, and other aspects related to operations. It is important to be aware of these regulations when investing in a hedge fund. Conclusion. We have come to the conclusion of our video on understanding hedge funds. We have discussed the different features of hedge funds, the advantages and disadvantages to investing in them, different strategies they use to generate returns, and the tax and regulatory implications they are subject to. We hope that this video has provided you with the necessary information and insight to make an informed decision about investing in a hedge fund. Thanks for watching and happy investing. This video was brought to you by Channel Success Mindset and Personal Growth. Subscribe to our channel for more videos on personal growth and success, and don't forget to like and share.